out of school, graduated 2008, 3 years of saving money.
2 duplexes, a fourplex, and a triplex. So I guess 11 units in 2016.
To get there from when you bought your first one, saved $25,000 with the focus on being able to afford something at that point in time, right?
I mean, what I think is interesting is everything that you're talking about is speaking to your, the mindset of what your end goal is. What is the end goal? Is the goal that I want to get rich quick and buy one property, or do I want that certainty of being able to, like you said, you lose your job or something else happens? Like, you've got a lot of backups.
Real estate's definitely not a get rich quick scheme, right? It's a get rich for sure scheme. You really need to have that delayed gratification and understand that it does take time. You can get into the exotic, flipping houses and things like that. But in reality, you gain wealth through real estate by
What is up, everybody? Welcome to another episode of the Seattle Living and Wealth Building Podcast. Excited to have you on the show today. We have some amazing topics to cover. The answer to all your burning questions about real estate investing. Should I buy now? Should I wait? Are prices going up? Prices going down? We're going to cover real estate 101, 201, 301, and even 401. So stay tuned. We got some amazing guests here today to cover all that. Mr. Ian Love, welcome to the show.
Yeah, thank you for having me. Excited to be here.
Wonderful. Glad to have you here. And our usual suspects, Justin Day.
What's up?
And Michael Dapper.
Hello, hello.
All right, so we got a lot of material to cover. So first of all, how the heck did you guys meet each other, and what brought Ian onto the show? And give us a little bit of background on that, Michael.
Yeah, so Ian and I went to high school together. Actually, we both grew up in Shoreline, and Ian has been a friend of mine, and I've been watching his real estate trajectory for a long time. So, he does a lot of things. He's an investor, he's an homeowner, he's done a ton of things, everything real estate related. He's going to be a great guest today to bring us all some new information.
Excellent.
Yes, sir.
Ian, do you concur?
I concur. It's all facts.
All right. Well, give us a little background on you and kind of your journey. We'd love to get to know you better first.
Yeah, so like Michael mentioned, we both kind of grew up in Shoreline, went to Shorecrest High School. Shorecrest was a place where, it was a public school. So we had, a good group of friends that were, living on Lake Washington, the wealthier group. And then we also had friends that we were close with, that were in apartments, and we were in the middle there. So we kind of got a good mix of all different types of people, different types of, friend groups. But also saw, at an early age, kind of what separated those families that, had that generational wealth, and what that was, and what I paid attention to early on was real estate. And I noticed that was a real difference maker for a lot of people. So as soon as I could, I knew I wanted to get into that.
That's pretty insightful, incredible. Like, at that age, what I guess led you to see that real estate was a big driver of that wealth?
Yeah, I think just asking questions of friends' parents, and how did you guys, end up here, and, what did you do? What steps have you taken to get to this point in your life? Like I said, we were kind of in the middle. My dad was a plumber. Mom was a hairdresser. So kind of got the entrepreneurial side more from my mom.
Uh-huh.
But also, the work ethic from my dad, waking up at 4:30 every morning to get going. He worked for the city of Seattle. But really just kind of, being inquisitive, asking questions of different, friend groups, families, and really just wanting to better understand how I could create that kind of wealth and success for my own family one day.
All right. So amazing. So you noticed that in high school, then you went to college, and were you at that point investing already, or what was your, path at that time?
Yeah. So I've always been a big numbers guy. So I didn't start investing until after school, but I went to school, got an accounting degree. It was 2008, 2009. So I was, thinking finance, accounting, how am I going to get a job in something that I'm actually going to school for? So accounting was something where I knew I'd be able to actually get a, decent job starting out and be able to start saving for my first real estate investment. So I started work in 2009 at Ernst & Young, went the public accounting route, and then soon after just was able to start investing in real estate.
So what was it that kind of, I mean, I know you were doing that for a long time as a CPA or as a working for a public accounting firm. And then I know you work right now, you said you work full-time at Amazon in accounting. Is that correct?
That's right.
And so to clarify for everyone, he's also a real estate agent, and that's part of your repertoire as well, right?
Yeah. So I can kind of take you through the steps of how I got started. So, came out in 2009. The market was flooded with foreclosures, bank-owned properties. And I knew immediately, just from reading books and kind of seeing how expensive, on average, people are spending 30 to 40% of their monthly income on rent or a mortgage. So I knew if I could reduce that 30 to 40%, I would immediately put myself 30 to 40% ahead of everyone else and give myself an opportunity to get into the real estate market and take advantage of those suppressed prices at that time. So I lived with a couple roommates for 2 years, saved up that money, saved up about $25,000 and bought a bank-owned duplex, lived upstairs, and then I rented the basement out. So the mortgage on that property was $1,400. I rented the bottom for $1,200. And then immediately just went back into saving mode since I didn't have to, again, spend that 30 to 40% of my income on a mortgage because I was house hacking. What's now termed house hacking. Back then it was just trying to save as much money as possible.
Yeah.
And then I took that money and I was able to take the savings, plus I did a cash out refinance and bought a fourplex. And then I kind of continued to do that every couple of years, bought another triplex, another duplex. Then around 2016, I started listening to a lot of podcasts, going to a lot of meetups, and I was just kind of starting to get impatient because I felt like this is going to take a long time. So, and I was reading a lot of, listening to a lot of people like the Grant Cardones and people saying, go big or go home. You've got to do these big apartment deals. So I started going to these meetups with other people that were doing apartment investing. And I met up with one lady who's a local syndicator. For those that don't know, a syndication is essentially when you pool your money with other investors. Generally, there's a general partner side and a limited partner side of that partnership. The general partners are responsible for raising the money, finding the deal, managing the deal. And then the limited partner side, they essentially are passive investors that are looking for a way to get into real estate, potentially learn from the general partners on how that they can invest their money into these deals. But they're much more passive. So it's kind of like a 401k, stock alternative. And they're not responsible for the day-to-day management of that asset. So I started in 2016 as a limited partner in one of these syndications to learn the ropes. Did that for a couple of years. It was a 15 unit in Spokane. I just invested a small amount, $25,000, to kind of learn the ropes from this gal.
And at that point, you had 2 properties to your name. Is that correct? You had the duplex,
units,
and then you had the fourplex. Is that correct?
I had 2 duplexes, a fourplex, and a triplex. So I guess 11 units in 2016.
Yeah, so that's pretty impressive to get there from 2009 or 10 when you bought your first one. Yeah,
10, 11.
10. Yeah, so you saved $25,000 with the focus on being able to afford something at that point in time, right? Yeah. So out of school, graduated 2008. Is that correct? Yeah, 2-3 years of saving money. And then you bought how much was the asset at that point? It was a duplex.
Yeah, so the first property I bought, it was, like I said, it was a bank-owned property. I bought it for $250,000. It's an interesting story. It was actually listed by Wells Fargo for $350,000. Mm-hmm. And the folks that had bought it previously in 2009, or in 06, they had paid $600,000 for it. Oh, wow. 2 Microsoft guys. And they essentially walked away because at that time their asset value was lower than the mortgage on it. Mm-hmm. The bank listed it for $355,000. I offered $250,000.
Awesome.
They said because I only had 10% down, so
yeah,
I gotta just throw some, take a shot here and there. They came back and said, don't even try to offer anything under $300,000. And then I came back and I said, I'll give you 260, but you pay closing costs, which are about 10,000. So it was pretty much the same net offer of 250, and they took it.
Wow.
So, a little bit of luck, a little bit of, not knowing enough to be scared of putting in offers like that.
Yeah.
But it was also a different time, very bottom of the market. I knew that bank-owned properties, they have a ton of these assets on their balance sheet. Why not take a shot? But yeah, that was my first one. That's how I got started.
Yeah, I wanted to rewind there just because, you go from two duplexes to a triplex to a fourplex, and next thing you know, you have 15 units.
Yeah.
But the point is, it can happen pretty quickly if you're in an appreciating market, and then you take that money, that appreciation, is that correct?
Yeah.
And you save more money. You're pretty disciplined with your savings plan, right? Knowing you wanted to purchase more assets. And then you did the cash out refi, allowing you to tap that equity to invest into another property.
Yeah.
Is that the right way to look at it?
And one thing, one way I was able to scale, without taking on investors is when you look at these small multifamily properties. So if you were to buy a single family, for instance, you wouldn't get credit on that application from any of the rental income from the property, because it's, you're either going to live there or, unless you're going to rent it out, I guess you could get credit. But the point is, if you were, for instance, if you're going to buy a fourplex, when I refinanced out of my original duplex and went to buy the fourplex, I was able to get credit for 75% of the in-place rents on the fourplex.
Mm-hmm.
So even though my income hadn't gone up as much, I was able to get that 75% on my application. So my income showed as higher. So I was able to actually get approved for my next asset. And that happened a few different times over the years, because I was able to increase my earned income, but also get credit on the next building because of the rents that were already in place. So it's kind of a way to scale without hitting your what's called your debt to income limit that banks will look at, and that they don't want you to get over a certain limit there.
I think there's a lot of people who want to hear the story and they want to kind of do something similar, right?
Yeah.
Maybe they don't have the entrepreneurial spirit or the strong desire to want to dive as deep into it as you have. But people can still do the same thing with single family homes where there's an unfinished basement and they can go ahead and finish that basement, rent it out, or maybe it is a finished basement, a mother-in-law suite of some form. They can generate income through that. It allows them to be able to save more money because, they're living in half of it, they're renting out the other half. There's a lot of opportunities there for people. It doesn't have to be quite as extravagant as what you did, but to your point, you can still take a portion of that rental income, count it as income, which therefore lowers your debt to income ratio, makes it that much easier for you to buy that next property. Yeah. And another thing that I want to make note of is, if you utilize it as a primary residence for 2 of your last 5 years, you can go ahead and sell that property and not have to pay capital gains on it as well. And so that's a huge benefit for people to live in a property for 2 years, go ahead and take those resources and if you can get a tenancy agreement for the upstairs that you've been living in, and then all of a sudden you can go and buy another place, and next thing you know, you've got this place that is generating 2 rentals, and then you have a new place that you're then doing the exact same thing too. I mean, it's house hacking, of course.
Exactly. And that's, I didn't think I was going to do a fourplex, then a triplex. I just started out with looking at a way that I could offset my rental costs or my mortgage costs. And I knew that, without making a dime on that, that 30% or the money that I'm saving, you're so far ahead of everyone else that's spending 30 to 40% of every check they get on living or housing costs. So if you can find a way to offset that, there's a lot of talk about saving money on your $5 coffee or your, gas. But if you really look at your biggest expenses, how can you reduce those? And housing is the number one biggest expense. So if you can find a way to even rent a spare room, or like you said, rent an unfinished basement, or a mother-in-law basement, you just are giving yourself so much more peace of mind. If you lose your job and you have a mortgage, but you're getting, most of the mortgage covered by your basement tenant, it's not as stressful, when you're starting out. It gives you way more if the market's going to drop, there's a lot of talk about, are we in a good market to buy or a bad market to buy? But if you are able to give yourself that cushion, offsetting, 50, 60 more percent of your cost, then you're just giving yourself more and more room and, more and more breathing room to not have to make that perfect decision, right? So, I just can't think of a better option for people that are starting out than house hacking or finding, a similar opportunity.
Yeah. I mean, what I think is interesting is like everything that you're talking about is speaking to your, the mindset of what your end goal is. So, a lot of people go, okay, I've got this duplex. That's a great way to start. All right, I'm going to hold that, and then I'm going to use that, extra income and buy my $1 million home. And then, hope to God I can pay for it. Your mindset is that you continue to kind of build slowly with, you're taking on some risk, but your goal isn't to get rich quick or like a single deal and flip it and make a ton of money and then I'm good. You're kind of going, you're going to long play with it, which I think speaks to, what is the end goal? Is the goal that I want to get rich quick and buy one property, or do I want that certainty of being able to, like you said, you lose your job or something else happens, that you've got a lot of backups, you've got a lot of things.
Right. Yeah. Real estate's definitely not a get rich quick scheme, right? It's a get rich for sure scheme. Mm-hmm. You really need to have that delayed gratification and understand that it does take time. You can get into the exotic, flipping houses and things like that. But in reality, you gain wealth through real estate by owning real estate over a long period of time. So just knowing that going into it will really allow you to kind of get through all the ups and downs and not be so concerned about the short-term market fluctuations. If you look at people that bought 10 years ago in 2008, 2009, or everybody wishes they bought more real estate at the last recession, right? Mm-hmm. But, now we're kind of getting to that point again where it's like people are thinking at this like exact point in time. But if you kind of zoom out and think 10 years from now, do you think people are going to regret buying homes in this market if they buy in a good location and they buy something that they can afford? They work with a strong, broker team, lending team that, helps them to put themselves in a good position that they can manage, comfortably. I don't think so. That's really how wealth is created. And, it's just can't think of a better opportunity for people to get into and learn.
Yeah, absolutely. The length of time in the market can cure, I guess, any short-term changes that are just on paper, right? The market go up 20%, but it's still kind of a paper gain until you actually sell it. You're not realizing that gain. So if the market goes down 20%, well, as long as you can afford that payment, you're going to be fine. Over the long term, again, we've seen that historically, real estate is always appreciated, roughly 5% a year over that long period of time. So you've been able to kind of build that portfolio. What I think is great about like having you on as a guest right now is you're introducing something that maybe not a lot of people are thinking about, is the benefit of getting into a duplex, a triplex, or a fourplex, where those are still considered residential loans. You can get a standard residential loan, but you can qualify for that with perhaps 3 of the units rented, and whatever income is being generated from those rentals, if that's $6,000 of income and you get 75% that as credited to you, you've just added $4,500 a month to your personal income, allowing you to buy an asset that is far more expensive than the asset if you just bought a single family home.
Totally. Yeah. You hit the nail on the head in terms of, when you get above 5 units, and what we're seeing a lot in the market right now is there's a lot of commercial debt that's coming due, because the U.S. residential market is one of the only markets in the world that allows 30-year fixed mortgages. So even though we're at a 6.5% rate right now, that 6.5 30-year fixed is guaranteeing you that you have that same payment that's going to be due for 30 years. Taxes and insurance may go up a little bit, but the fact that you're guaranteeing that you're not going to have a balloon payment, or the payment of your entire loan is not going to come due won't come due for 30 years.
Yeah.
That's, we're one of the only countries in the world that offers that. In Canada, for instance, they generally have 5 or 7 year fixed. So that's more.
Show me the money after that.
Yeah,
Right?
and then after that, you have to refinance, and then whether the rates are up or down, you just have to take that chance. So like that's what you see in the commercial markets right now, where a lot of these apartment owners, office buildings, they bought these buildings 3, 5, 7 years ago with a 5-year fixed rate, because I think the max that you can get is 10, but most people do 5 to 7 year fixed rates. So when they bought the asset, their interest rate may have been 3%, which, the rents at the time covered that debt payment. But now 5 years later, the debt payment, when they go to refinance, is actually more than any of the rents that are coming in on that property.
Yeah.
So they either have to bring more money to the table to reduce their total debt amount, or they're going to lose the property. So a lot of people are, on the fence right now, are on the verge of losing their properties, and we're going to see a huge influx of more properties coming onto the market and essentially getting revalued at a lower value.
And this is a commercial space, correct? Right. Just to be clear,
yes.
right? 5 units or more.
5 units or more. So it just highlights, 1 to 4 units. There's just so many benefits in terms of you get the credit for the rent. You still have a 30-year fixed, so you're under the residential lending guidelines. Lower rates. There's just that 1 to 4 units a really nice sweet spot for investors as they're starting out. And also just kind of learning how to be a landlord too, right? Because, when you're house hacking, you are a landlord. That's you're a first-time landlord. So a lot of people get, scared off by that. But I would just say, is it worth saving an additional, 30% a month, not having to worry about if something happens with your job, giving you that 30% head start on everyone else that you know? And then also, thinking ahead, once you move out of that, you can rent those 2 units and use those 2 units towards your income on the next one. And then you have, these 2 tenants, 2 to 4 tenants paying off your old property while you're in the house that you actually want to be in. The first one's not always your dream home. So just kind of using that as a stepping stone is like, think about just that one move 20 years down the road. You've got this place completely paid off, and it's paying, you got these tenants paying for your living expenses. That one move can really create generational wealth and set you up for the rest of your life.
I think this is a bit interesting to hear, because I didn't say this at the beginning, but it would be really good to know, okay, you bought your first place in 2010, right? You started to accumulate more units. Tell me now how many rental units that you have.
So I have 27 units now in Seattle, in a fourplex over in Molly Terrace, just north of Seattle. But, from that 2016 to last year, I kind of went on a syndication journey, I would say. So after I did the limited partner, got my feet wet, understood the kind of the back end in terms of, what are the legal documents, how do I pull together a deal of my own. So in 2018, I did my first raise, was about $700,000 on a $2 million 7-unit property over in Central Washington. And then from there, partnered with a couple other people, and we did a 175-unit, $5 million raise on an $8.5 million property in Arizona and Tucson. So along that time, we got up to about 30 million assets under management is what they call it. And I think around 255 units were being managed. But having gone through that journey, I've actually been able to find, coming out of that after selling those 2 syndication deals we sold last year, you can actually make just as much or more money with the smaller deals and owning 100% of them as you can raising all of this investor capital and then, managing investor money, managing investor expectations. But a lot of these people that speak at conferences and around the country that get on stage and say, we own, assets under management, or we own 500 doors, but really in reality, they own, 5% of 100 doors.
Mm-hmm.
So you could easily own a fourplex yourself and have the same personal portfolio as somebody that's on stage talking about managing millions and millions of dollars or hundreds of doors. So I think it's just really important for those folks to, for people that hear that, to not get overwhelmed and not feel like they have to be out there, doing these 100-unit apartment deals, because you can really, can achieve that generational wealth and achieve that, that peace of mind and that freedom, financial freedom for your family with just a few, strategic deals. So that's kind of the journey I've been on as far as, we sold the 70 unit, in December for $3.5 million.
Uh-huh.
And then we sold the 175 unit for $18.9 million. And it was actually kind of a full circle moment because we sold it to a Grant Cardone mastermind student. So kind of the reason I got into the big apartment buildings was kind of the way I was able to get out of them too.
That's interesting. Yeah. I mean, Grant Cardone obviously is a very, charismatic, successful, big time real estate investor, has programs that people buy into. And what I like about what Ian is saying is that you don't have to get into that sexy activity of syndications and multiple units and raising all this capital. You can just be a regular old investor and just focus on small 1 to 4 unit properties. And then what you can do over time is just leverage that into owning more and more real estate. And you don't even need to go there, is right. You can just start to be a single family home investor and you get some capital. Eventually you can afford a new home because you've got a job and you make more income. You keep that property, keep it a rental. You can accumulate multiple assets in so many different ways. But often we do talk about single family investing here. So it's great to dive into the benefits of owning duplexes, triplexes, and fourplexes.
Sure.
Yeah, I think, to go back a little bit, I mean, when you're talking about trying to, like, the word investor, okay, it can sound very overwhelming for certain people, right? If they're buying their first home and they want to build that generational wealth. When I hear the word investor, it sounds to me like we're talking the syndication deals, we're talking, buying tons and tons of real estate. But at the end of the day, people have the goal of trying to build that generational wealth, and you don't need to do that with a ton of different properties. It can be, you buy a single family house, it has that unfinished basement, you're able to go ahead and finish it, you go ahead and rent it out to someone. I just think back when I was a kid, my parents, I grew up in a single family house, very modest. My parents ended up buying a new house and rented out that existing house that they had. They were able to do that. But the reason they were able to do that was because the new house that they bought was a large house and it had a 2-bedroom suite in the basement. And so they were able to rent that suite out and therefore cut down their mortgage. And it was, an amazing way for us to be able to upgrade our lifestyles. And, the house was way nicer than the other one. But the point is that we would never have been able to afford it if not for that rental income. And so, that allowed my parents to be able to upgrade on this one house that they had as a rental. They had a rental suite in the basement that allowed them to be able to afford the one house. And, this is in Vancouver in Canada. So, obviously the real estate market went like this and, clearly it worked out well for them in the long run. But, they didn't do anything extraordinary. Right. They just simply took these opportunities that were available to them, were able to take that one leap, push the envelope a little bit for themselves, and then ended up really working out well.
I think, a lot of people listening to this are going to hear $20 million. They're getting 175 units. They're like, wow, how do I do that? But what you're saying is that, like, although you can do that, you can also do it a different way that have way more ownership of it. And I think that's where the nuance is, where it's really easy to get excited about big numbers, but you can generate those big numbers for yourself in a much more straightforward way where you're not becoming this, fundraiser, sophisticated.
Yeah. What's your view on like short-term rentals versus long-term rentals? Because right now short-term rentals are definitely a big hot topic. Airbnb obviously has done that. What's your strategy?
Yeah, so I definitely think there's money to be made in the short-term rental space. For me personally, just with all I have going on with the day job, being a real estate broker, um, an investor myself, and then managing.
You got nothing going on. Yeah, there's
I'm newly married. But for me personally, the juice just isn't worth the squeeze on trying to kind of get myself in the hotel business and try to maximize the returns on some of my rentals. My approach has always been, stay a little bit below market in terms of the rents, find a good long-term renter that's going to be there 5-10 years, and just take care of them. And then I kind of understand that, my cash flow short-term may be a little bit lower than the Airbnb guy, but I'm in a position to hold these assets for 10, 20, 30, really the rest of my life. And I know that on the back end, through appreciation, through these tenants paying down my mortgage, over time, that's really where the wealth is created, even more so than the cash flow. Mm-hmm. I do see a lot of the younger generation getting into Airbnb, and that a lot of that is primarily because their earned income is not where they want it to be, where they're a full-time kind of Airbnb host, for instance. But I think as you get older, that kind of the cost benefit analysis of getting into Airbnb, especially if you're going to have a family and you're managing these buildings and you're dealing with people checking in, checking out all the time. For me personally, the peace of mind of just a solid long-term rental and kind of just playing the long game kind of beats out that extra few $100s a month that I would maybe get on an Airbnb.
Okay. Yeah, that's what I thought. That's why I wanted to hear that answer again, right? Because it's like sexy. What's sexy? Airbnb. But, we've got long-term renter that I just signed, renewed for 2 years. I actually lowered their rent because they signed for 2 years on the renewal, but they're also renewing 6 months before their current lease expires. So that's just nice to have that security where I don't have to worry about the turnover of that tenant. So there's a benefit of long-term. Then, of course, we have our short-term rental in Phoenix, which is managed. So we're fine taking that 25% reduction in the revenue, but it's managed every single day. So there's, again, just different ways to go about it. I wanted to also make sure that we spent time talking about one of the changes that is happening in Seattle zoning laws, and it's how we've moved to where the city is supporting more density, and traditional residential single-family lots can now have 3 rental opportunities by having a single-family lot and a DADU, detached ADU, and an attached dwelling unit. How do you see that changing the landscape of investing in Seattle?
Yeah, so the ADU market, not only in Seattle but around the country in high cost of living cities, is really a way that local governments have been seeing as an alternative or something that can offset rising housing costs and create more affordability and more density in these bigger cities. We're seeing it in LA. Las Vegas just released similar legislation. But in Seattle, what's great about it is they're not only letting you create these additional dwelling units and detached additional dwelling units as rentals, but they're now actually allowing you to subdivide and actually what's called condominiumize. And you can actually sell off the additional dwelling unit and the detached additional dwelling unit as separate parcels or separate homes. So very similar to like a townhome in terms of from a buyer perspective or kind of how you would visualize it. But it's a trend that I don't see going anywhere anytime soon, both from a buyer perspective or an investor. It's an area that I really am urging a lot of my clients and friends and anybody that will listen. You really need to get in on this ADU opportunity, because the people that I'm plugged in with in terms of builders, developers, people that historically have jumped on the townhome wagon when that was a big thing 10, 20 years ago, that have built big apartment complexes. More so than any of that, everyone is looking for a single family home on a big lot where the house sits on one side of the lot and then it's on an alley or on a corner where you can build one of these detached ADUs on the backyard. It's the number one investment opportunity out there for anybody that's in one of these cities. And to ignore it would be, at your own, your own risk, because, the money that you can make on these things and the opportunity, it's only going to be around for the next few years because, people are gobbling things up. And if you look on the market and you actually kind of look at what I just said, you'll see that as soon as those things get listed, they're gone in 24 hours. So no matter where interest rates go, or how bad the market could get, this opportunity, the margins are so high and the opportunity is so great that it offsets, even a 20-30% drop in housing values, because you can make so much money on these things.
That's good stuff. I mean, this is advanced level investing. We're getting into 301, 401. I wanted to make sure we covered this.
Yeah.
Well, and I think, even on the other side of that, let's just look at it from a buyer's perspective who's not looking to invest. Yeah. I mean, I had some clients who in the fall purchased a condominiumized property where they built it was essentially a single family house in the back, and then it's part of a condominium association. But they're great opportunities for people to live in more urban environments, in townhouse style living, I guess you could call it, or really it's single family house living. But I almost looked at it more like a townhouse. But they're great opportunities for people to be able to live in those urban environments.
Yeah, and just as you said, it's a townhome alternative, but without the shared walls, especially the detached. You've got a little more privacy, especially if it's on an alley or a corner where you've got separate entry, parking, garages oftentimes.
Mm-hmm.
So it's actually more attractive to a lot of buyers than a townhome where you have shared walls, for a similar price point as well. So something to look for.
What's the key for being able to execute on this, aside from having some money of your own? Did you develop a list of contractors? How did you get to this point where you could start, doing this yourself? Beyond just kind of buying and painting it, getting into these development opportunities.
A lot of networking. One of the mentorship groups that I'm in, I've been able to get a lot of referrals from that community in terms of contractors and builders. So that's probably the biggest thing is, going to your realtor, going to your lender, and there's people in the community that are already doing this. So just being open to, coffee and kind of reaching out those or seeking out those types of references. And then trial and error. You start with a smaller project. I wouldn't start with a contractor for the first time using them as a basically a dadu developer.
Uh-huh.
You really want to make sure you've got good referrals, got a good working relationship. But when I'm doing, for instance, a single family with an unfinished basement, you might start with a smaller piece of that project and trying out a new contractor to see how they do, as opposed to, the full-on, full scope of work. Maybe start with something smaller like a bathroom or something like that, where you can get a better feel for how they work, how they operate, and then earn that trust over time. So, there's probably starting small and then also just relying on your network and building your network.
Yeah, good advice for sure. People always say it's hard to find good contractors. So executing on these opportunities and being able to capitalize them, you need that good team in place. All right, so give me. I want to talk about a couple interesting things. So one of them is, tell me about the funniest thing that happened with Mr. Dapper here. You got to share some stories here. Yeah.
Man, we were different grades, so I wasn't behind the scenes on his funniest moments, unfortunately.
That's a good thing.
Do you have any that you want to share?
Nope, nothing I want to share. I just when you said that,
look how ready he is right now.
You said in high school when you were focusing on paying attention to, who had wealth and who didn't, and figuring out that it was real estate. I can tell you, in high school, I wasn't thinking about that. I was thinking about something else. Yeah, taking up my time. So
yeah. I wouldn't say I was, focused on that either, but those conversations come up when you're, hanging out.
Right. Good. Yeah. I mean, I think that's the thing right now is there's a big trend in understanding how to invest, how do we get started? So as we've talked about, and we've talked about some of the burning questions, should I buy now? Well, if you have the financial ability to buy now, you feel secure about your job, yeah, go ahead and buy now and invest and hold in the long term. Should I invest now? Well, if you can get into a duplex or a triplex, an even better investment and leverage off of other people paying your rent, that's an even safer investment. So do you feel like prices right now are going down further a little bit or on the way up? What would you say?
I think right now they're fairly stable. I think, rates, I would expect them to go down slowly through the end of the year, probably end of the year closer to 5.5%. It's my best guess. I do think, there's opportunities right now where the general public is kind of sitting out. I would say there's very low inventory, but there's not quite as many buyers as there were last year. And a large part of that is because the ones that may be in the market are a little bit scared off by the headlines, and they're kind of wait and see mode. But for those people that are that are willing to spend a little bit more time going a level below the headlines and actually seeing how could I get into this market? I'm a long-term investor or like a long-term buyer. I'm going to hold this property for 5 to 10 years or longer. There's opportunities out there right now to get in with very little competition, but also work with a lender and a seller, that will, there's 2-1 buy down programs where the lender or the seller essentially gives you a seller credit for 2% of the rate. So if you have a 6% rate in year one, or a 6% rate is the general rate that's out there, the seller as a closing credit will pay your rate down to 4% in year one and then 5% in year two. And then in year three, that's, within the next couple of years, I would see rates being in that 5%-ish range anyways. So you have a chance. And at that point, I would see, prices continuing to go back up again. So I think it's just a great opportunity to get the right property, take advantage of one of these tools that are out there. And then, you're actually able to kind of get the best of both worlds a little bit, just by being a little bit more, diligent beyond just kind of hearing the headlines and taking that, as gospel. So there's definitely some advantages and some opportunities out there for the people that, want to learn about those loan programs, want to get the right property in the right area right now without the competition. And then another level that want to look for those types of legislative or law changes that have been available, for instance, with the ADUs and the DADUs. It's a great time to actually take advantage of that and get into that space without as much competition as you're going to see starting again probably in 2024. So there's definitely always opportunities, I think. It's just a matter of, like you said, if you're in a financial position to be able to take advantage of those. The first thing is getting your house in order and making sure you've got the the financial well-being to support that mortgage long term, and then also you have the proper reserves in place to give yourself that peace of mind to make that decision.
Absolutely. Couldn't have said it any better. Well, any parting thoughts, guys? Final words as we wrap up here?
Yeah, I wanted to just go back to the Airbnb thing for a second because, one thing that I've been thinking about personally as well is I obviously have an Airbnb property, as everyone knows, in Phoenix. But one thing you can do as well is Airbnbs obviously require a lot of hand-holding and there's, a little bit more time invested into it. But it can make a lot of sense for people if they have a basement that can be converted into a suite of some form and make it an Airbnb property. And that is an opportunity for you to be able to increase that income. It's easier to manage because you're right there doing it yourself. You can even clean the place yourself. You can do all this stuff. And that's a massive way to increase your affordability for your home. And then therefore utilize that income that you're generating to be able to buy that next investment. So if you're someone who has a property where, you can convert that basement into a suite of some form, Airbnb is a great option to do that. We're not necessarily talking about someone who wants to have 100 doors, right, but someone who just wants to buy another property as an investment, just one property. That could be a really good way of doing it.
I totally agree. And I think it's a great way to kind of dip your toe in the water as a landlord
Totally.
and see, maybe I'm not ready to sign up for a 12-month lease with somebody that I don't know.
Yeah.
Maybe starting out with an already furnished area, getting that thing ready and then seeing how it goes with a few, and then probably will get addicted to that extra money. And then maybe you're going to be
Yeah. Well, and guess what? What if you want to have your family come and visit you? Well, guess what? You've got a fully furnished suite there. If you have friends that are coming to town, or if you want to utilize it yourself, I mean,
yeah,
maybe you got to sleep on the couch. Instead of sleeping on the couch, you get to go into your suite. But anyways.
How about you, Michael?
I think the takeaway is that the row is starting small, and like Ian said, the property suppressed market was 355. He shot a shot at 250. There's a lot of people that would count themselves out, not even try that, but that one decision just to say, hey, I'm going to give it my best, that now has exponentially grown his wealth and his knowledge of real estate. So take your shot.
Absolutely.
I don't think we're going to see many 260,000 plus closing costs acceptances on a $355,000 place, but
we'll all do.
Yeah, I get what you're saying though.
Yeah, just get into the game is the point. Right?
Totally.
Yeah, however he got into it, not about
Not the price.
not look for the foreclosure and then go for it. Yeah, absolutely.
Yeah.
Well,
I think also,
okay.
You just don't want to lose. If you find a property that you really like in a great area and you're planning on holding it long term, you don't want to lose that thing over $5,000-$10,000 or whatever it is, right? Because when you look back at people that have owned properties for 20, 30 years, and you hear how much they bought them for. If they added 10,000 to that, you'd still be like, wow, that's amazing that you got it for that price. So you don't want to look back 30 years from now and have missed out on that opportunity, especially if it's a really good one that you love. I think have conviction. If you feel comfortable with your, the lender's telling you you're good, your broker's telling you this is a good deal, put a solid team around you, but also don't be scared, like Michael said, to take action and have conviction in that decision, because ultimately that's what it takes in real estate.
Yeah,
Love it.
absolutely. Well, we went deep into real estate. Like I said, we cover 101, 201, 301, 401, all things investing. Hey, if somebody wants to get a hold of you, talk through things, what's the best way for them to get a hold of you, Ian?
So my Instagram is Mr. Love 206.
Awesome.
Definitely reach out anytime, trying to, spend more time on there, educate people on building wealth, owning real estate, and avoiding some of the pitfalls that I've made over my career. But yeah, happy to help out any way I can, and reach out anytime.
Don't forget Mr. Love 206, MR Love 206. You can't forget that one. You heard it here, folks. That was a lot of fun. Thank you, Ian, again. Thanks, guys.
Thanks, Ian.
And we'll look forward to seeing you on the next episode, everybody.